but whatever. Okay, so oil prices are up a lot right now. I did a short video yesterday afternoon highlighting some of the risks of escalation from what we were seeing over the weekend, way beyond, um, way beyond what folks were talking about. Um, it is stunning to me to see this sort of narrative shift over time, where in January, most of the folks that you'll see on TV and podcasts and whatever, actually almost everyone was out there calling for a super glut for oil. There were some folks calling for $40 oil for 2026. And then some of those folks actually still were telling people to short oil after the Iran war started at the end of February and early March. There were some memes going around. Some of the Canadian sort of scam folks or whatever were pushing this, and some other folks. And so it is sort of amazing how little pushback they get from their followers and sort of publicly. And so I guess I'll say it here. That was sort of a terrible call. And well, not sort of, it was a terrible call. And I think generally, uh, one's expectation should be that everyone's crystal ball should be broken in the short term, but that over the medium term, we should be able to call these things relatively well and understand what's going on. Um, but when there's folks that are sort of persistently wrong in both directions, and they make really sort of aggressive calls on companies, and they're wrong on those too, and so on, I think it's worth investigating their incentives and their affiliations and alignments. And in many cases, unfortunately, there's folks that are getting paid to do specific things that are completely unaligned with their audience, and they're not disclosed. And so it's actually one of the big motivations I had for launching Bison Insights, which was I saw a number of these folks here on Substack as well as on X and various other places. And I thought it'd be helpful to start a newsletter where I share individual ideas and then track the performance of them, not sort of ad hoc, sort of like made up. There's a number of folks, some of the top sellers here on Substack, as well as many other places, that sort of just declare victory over and over again. They'll say mutually contradictory things. They'll sort of make amorphous calls, and they'll say, I was right over and over again. And not doing it like that at all. And again, I actually think there's room to sort of contrast with that very nicely. And the way to do that is to say, hey, I think XYZ stock um, is interesting and I own it and I think it goes up. And to track the performance of that, or XYZ warrants, are mispriced and they should be up or down or whatever, to share position sizing and to track it. And not every idea that I've shared on Bison Insights has outperformed, but in aggregate, they've massively outperformed. And I've continued to show the performance when it's outperformed and when it's underperformed. And I just think it's very important to do that. And I think that there's sort of a base level of um, honesty and disclosure that's missing in the public discourse around oil and oil and gas stocks and so on. And here I'm going to show just very briefly this. And again, I'm seeing it even today. So the reason to talk about this is what we're seeing right now, where there's a number of folks that they were bearish oil in January, very vocally bearish, calling people all kinds of names, insinuating violations of fiduciary duty, sort of crazy stuff, for like having long positions in oil. And of course, oil prices skyrocketed within a couple of months, both because of the war, but also the super glut that many of these pundits and alleged experts and so on were forecasting didn't show up in the data even in January and February before the war. So anyway, so my thought is, hey, let's show performance of these ideas. And again, this isn't my fund, which I run a fund. This is not a solicitation for it. This is tracking specific ideas in the public domain for everyone, not for, only accredited investors. The downside is that unlike my fund performance, this doesn't include sort of commissions. It's not actual trades. It's ideas, but it's tracking them on the unaffected price. So the day before I write about it, to the day before I close out the idea. And I've closed out two. One was almost a 10x and one was a 3.4x or so. And those are great. There's one idea that's down, I think 60% or so from where I shared it. So that's pretty bad. Those were all small ideas. Some of the larger ones have outperformed, some have underperformed. In aggregate, measuring them, and the way I've been doing this on the Bison Insights Composite Index, there's been material outperformance. So anyway, so a lot of these folks that were pounding the table bearish on oil in January, and then in many cases actually reiterated fading, they call the geopolitical risk, whatever, fading this event in the beginning of March, got ultra bullish oil by mid-March to early April. And many of these folks were all over TV and podcasts and other stuff, sort of almost as if they were trying to hide their previous calls of super glut and bearish oil, sell oil, short oil, whatever, through sort of being so vocally bullish oil and so on. You saw this with journalists, you saw this with pundits, you saw this with newsletter salespeople, saw this with fund managers. I mean, it was sort of like really disappointing and I think disingenuous across the board. And so, um, almost everyone, like this isn't about any individual person. This is, I think, about sort of the general public discourse has been terrible in my view, really sort of abysmal. And again, like there's only so much I can do. I'm not going to go call out sort of individual people by name. It's not necessary. It's not constructive. But I think calling out this sort of behavior is really important. And then setting a bar where, hey, here's these ideas and here's their performance. And I've been tracking the individual ones. It's just there's 17 now. So it's sort of getting the chart on the relative performance for each of the individual ones is getting a little busy. And so been more focused on sort of this aggregate. But I'll show intermittently the individual performance too. And again, it's not, the point isn't that I'm brilliant. I think I'm good at this and I've done it for a very, very long time. And I think I play sort of in the kiddie pool, sort of the ultra shallow water where there's extreme mispricings and where there's real opportunities to materially outperform over time, measured in months and years. And, I think there's a lot of potential. There's also a lot of risk playing in that sort of pool, but there's a lot of potential upside. So, I think there's some benefits, but the flip side is that's a benefit for individual investors. And that's something I've talked about for years, where there's a lot of folks that'll go out there and say, you should buy, which first of all is highly problematic. I don't know how they get away from that from a regulatory perspective, but also like, how do they know your personal financial situation or preferences? They say, you should buy Exxon or you should buy XYZ big thing. And there's several problems with this. One, again, they should not be providing individualized performance recommend or individualized investment recommendations because they don't know your financial situation. I will never provide you with an individualized investment recommendation. It's not what I do. I share what I'm doing and where I see value. But the other big problem is that for small individual investors or even large individual investors, you have a huge advantage over institutional investors. You get to deploy less money. And so when I get to deploy less money, I try to find the things that are most likely mispriced by the most amount with the highest probability of repricing by the most amount. And so I think there was a book that came out about this. It was like the big secret for the little investor. And many other books like that. Greenblatt wrote his like little book that beats the market. Very, very sort of similar ideas. The magic formula he wrote a book on. There's a lot of these sort of similar ideas where basically as you get smaller, you get these big advantages in terms of potential performance over time, if you're right. And, even, I mean, I went to University of Chicago and I studied economics and I interacted with a number of folks there that did a lot of sort of research on the finance side. And if you look at the FAMA French models, again, University of Chicago economists, finance, the academicians and so on, that they will acknowledge that you are basically, as you go to smaller cap, as one goes to smaller cap investments, there's more likelihood of mispricing. And in many cases, there's actually systemic outperformance in exchange for the illiquidity and the perceived additional risk and so on. And so even the efficient markets folks expect a higher return in the area that I choose to focus on and that I write about, but also in an area that's, I think a lot of these opportunities come partly because institutional guys can't invest in it. And so what they'll do is they'll speak negatively about it. They're consultants and, other sort of folks that are trying to sort of leech off the space, get very aggressive, sometimes anonymously, sometimes under their own names, but they often don't disclose what they're actually doing, attacking this space, really critical of it. But again, even purely from the pure finance perspective, you're likely to end up with, not you're likely, but the studies show that there's outperformance small caps versus large caps, especially if there's any sort of edge or skill or whatever, because there's more mispricings and there's less information and there's higher value for that information per dollar invested, but there's lower value overall for that information because there's fewer dollars that can be invested. And so there's real, just enormous potential edge here. And again, does this mean that Bison Insights Composite Index should have been up even more as of July 10th? Yeah, right. Like I made some mistakes. Should it be up 80%? Sure. But like, that's, again, I'll acknowledge that. And I think it's a very important aspect of this. But I also think it's really helpful to consider that and to consider sort of what we hear in the public domain, who we're hearing it from, and what their incentives are. And my thoughts have always been that I would rather earn higher returns on less capital than vice versa. And it's pretty fun to get to write about some of these things here on Bison Insights. And I think there was some concern initially that I would write about stuff and then just close it. And again, like I've closed 2 ideas out of 17 that I've shared, one of which was after almost a year. Another was after, what was it, 2 or 3 months, but the company was getting bought, and which I actually didn't expect. It was one of my risk factors that they would get bought. So, just really nice surprise, I guess. I actually thought there was more upside there, potential there, but it needed to not get bought. So there was a material change, unexpected, negative in my view, but positive performance in one. But otherwise, these are things I'm sharing. I think they're really interesting ideas. I think there's a lot of upside here. I'm really excited about them. And I'm actually going to do a short subscriber only space after this where I go through some of the specifics of some of the positions that I've been adding to, and some of where I think there's some real mispricings here. But getting back to sort of what's been happening. So there most of the pundits and experts and fund managers or whatever were bearish oil in January, bearish oil even going into early March, even the start of the Iran war, ultra bullish in April, and then started to flip. And again, credit to the few folks that started to get bearish oil in, let's say, May. Very brave view. In many cases, the fundamental arguments were wrong, but still they sort of, I guess, read the chart right or whatever. And then at this point, most, it looks like, of the pundits actually got bearish oil after oil fell from 107 or 110 or whatever WTI down to the low 70s and into the 60s. At that point, you started to see a lot of folks get real bearish oil. And so that was sort of another one of those funny, it was sort of this like wrong and then wrong and then wrong sort of calls. And then you're still seeing, I think, a lot of that inertia of folks doubling and tripling down on being bearish. You saw a number of the super glut calls reiterated. The IEA is calling for that, and some of the investment banks sort of seem to gear off of the IEA numbers. The EIA also had some very interesting, very oddly bearish forecasts. They've unfortunately been sort of more politicized and more wrong over time. And even folks like Reuters have written about this, where they pointed out that the EIA was showing these numbers that were persistently bearish for demand for gasoline versus the reality. This was in the Biden administration, but they've actually continued like that under Trump with the same sort of error bias, which is very unfortunate. I got a comment, most pundits are basically a 30-day moving average. Yes. If you basically justify the 30-day moving average and create that as a Substack and you have some sort of following or whatever, you can build a giant following if you're a good storyteller and just do that. And people will think you're brilliant, even though you were wrong almost all the time. It is amazing to watch. Just look at that top 50 list, and there is a high percentage of folks. There's some folks that'll plagiarize my work and other people's work, which is annoying. And I'll probably just sue the next group that does that, and maybe the next 5, just to sort of make a point, and to try to discourage that sort of behavior. But there's a lot of a lot of this sort of just like looking at what the futures market's pricing in and then just sort of telling some sort of story, sometimes making it really fancy, embellishing it, and then always declaring victory, whether one is right or wrong or whatever. I do not do that. I don't like to do that. I'll take some very, very contrarian views, like the view that I published this weekend. And, I think there's some benefit to that over time. One, in taking contrarian perspectives, and then two, in playing in a sandbox in the sort of shallow end of the pool where there's not as much competition and where where there's more risk, but also where there's sort of more available information. Again, from an information problem perspective, from an economics perspective, there's more edge that's available. That's relatively economic to obtain, um, where it's not maybe possible on the Exxons or Chevrons or whatever of the world to get that sort of edge, especially as an individual investor. So I think there's a lot there. So what are we seeing right now? We're seeing this inertia from these folks that were wrong and wrong and wrong and wrong, that are wrong again. And so I talked about this yesterday and talked about how infrastructure was starting to get hit. And now infrastructure starting to get hit was a real sort of indicator. There was another indicator on the reimposition of sanctions a week ago in Iran. And then there's one that I published that I'm not ready to talk about publicly, where there was this very rare signal. And I'm not really a technical guy, although I guess I'm, learning more about that and various other methods to try to just get better. Anything that's sort of legal and available to become a better investor, I'm happy to sort of explore and better understand. And there was this one indicator where it's fired just a few times in the last few decades that has had a 100% hit rate so far. Again, this doesn't mean that it will have that sort of success rate going forward, but I mean, if I'm going to use a historical indicator, I might as well use one that's always worked so far, without a guarantee that it will work again. But it seems like the odds for that seem very, very promising. And so I'm it hit, and I shared that view, and so far so good. And I think there's a lot more to come there. And what we're seeing is a lot of folks who are still very, very bearish oil, weirdly. And I was posting on X about this, or Twitter. Basically, I think that as we get oil over, let's say, 90 or so, I think we'll see a number of these sort of flow with the wind or 30-day moving average or whatever folks flip and get very, very bullish. In some cases, I think it's a political thing. I think they're actually trying to pressure the Trump administration to stop the Iran war, which is sort of messed up. Again, like, I'm generally pro peace, but I'm also pro freedom for the Iranian people. And it was really horrible seeing tens of thousands of them get murdered by their government. So I think it's a very morally complicated situation. But seeing economic pundits and fund managers and various other folks come out there very aggressively with economic calls that seem disassociated from reality, but seem sort of politically oriented. I think that's pretty misplaced. It's especially interesting to see non-Americans do that, trying to sort of impact American foreign policy, American military policy, and so on. So my expectation would be, as we see oil go up, we'll see a number of these folks flip. We may see a number of the investment banks that have put out bearish views flip again and put out bullish views, or reiterate their sort of bullish upside cases, or so on. It's going to be very, very interesting to watch, to the extent this continues, which it seems increasingly likely that it will continue. Trump today announced that the U.S. is going to impose essentially a 20% tariff on exports through the Strait of Hormuz, and is reimposing the blockade on Iranian oil and Iranian ships. And we'll see if that gets imposed. There's some discussion that maybe it takes a day or something for that to get started. Iran did export a large amount of oil, which was a physical factor that was pushing down on oil prices in the short term in June. Excuse me. And then the thing that I started this to talk about just for a minute is the news that the Houthis are starting to fire on Bab el-Mandab, and are starting to fire on Saudi Arabia, and that Bab el-Mandab may come into play. And so here, let's put this up. This is X. My friend Energy Bruta reposted this from the Hormuz letter. I don't know who runs that account, but they're not always accurate. But this sort of stuff, they seem to be pretty good at. Press TV. I'm not sure where it's from. I imagine it's something that's Iran related, or sort of one of these international news services. This seems pretty likely. They're talking about closing Bab el-Mandab. This is a scenario that could result in oil prices rising to $200 a barrel, and this is worth following. And I started this space because I saw the news that that Houthi rockets were getting fired at Saudi Arabia. If you don't remember, in 2019, the Houthis fired at Abqaiq in Saudi Arabia and knocked off Saudi production for a few weeks. With the East-West pipeline running, and with a lot of, if not all of, Saudi exports going through that right now, there's a lot of risk because there's only a little oil that can go through from Saudi Arabia up through the Suez Canal and through the pipes up there. Most of the oil has to come down through Bab el Mandab, which runs along Yemen and is near the area that the Houthis control or sort of control. And then there have been, it looks like, some Somali or other pirates that have been harassing ships coming out through there, and that could ramp up a lot too. So that's sort of the scenario where you could see new inflation adjusted all-time high prices. You could basically see me swap out this hat for that hat. This is not something I'm celebrating. This is a horrible thing from a global economic perspective. The Houthis are horrific. They're sort of, if you want to think of like a spectrum of folks, I think as like sort of a liberal Westerner wanting peace and democracy and freedom and free trade and low taxes and just sort of peace and goodness and happiness. They're sort of on the extreme end of like radical revolutionaries trying to break the world and, you know, force everyone to adhere to their particular extreme theology. And so, you know, easy to root against them. That being said, they may force oil prices up a lot. And again, this isn't about what I want. This is about just seeing what's happening. And there's only so much I can do. I can say, hey, I want there to be peace on earth, and I want Yemen to be a free, non sort of theocratic dictatorship run by crazy, aggressive revolutionaries. Same with Iran. But then it just doesn't matter what I want. And so, rather than trying to focus on that, I don't run a think tank. I run an investment fund and I run an investment newsletter. And so, for this newsletter, and then for my public commentary, really what I'm just doing is trying to share what I think is going to happen, and then what I think that means, and then what has happened and what I think that means, both from a macro perspective as well as from a company perspective. So, I think oil prices could go up a lot here. It does not appear like they are priced in. I did add meaningful exposure both to equities and to some of my sort of right tail positions here. And I think that there's some room for this to run. I think that we're going to, like I was saying, see some of these sort of go with the wind type folks go from bearish to bullish. As that happens, the next time almost all the investment banks at ultra bullish oil, whatever, I would expect to actually pull back on some of my positions, whether it's cutting right tail calls and whatever, or whether it's through just cutting some of my exposure to some of the longer term oriented equities if they run a lot like they did in March and April. Just because from a risk management perspective, like we saw in May and June, there's a real chance that things heat up and then cool off. And one of the best indicators has been these banks getting all bullish, like I was talking about, and experts and pundits and whatever, just sort of that whole world of alleged experts, who again, sort of, as this one commenter said, they're basically a 30-day moving average. So fading that, betting on reversion to the mean to some extent through just trimming positions and taking profits and so on is something that I may do. That being said, right now here, there's a lot of upside to oil and to some of these equities. There's one idea I shared that almost doubled from March to May and then has pulled back almost 50%. That's just wildly interesting. And I was buying some more this morning. I'm going to talk about that in a second with the Bison Insight subscribers. I'm going to talk about some of the other stuff that I've been adding to. And then there's some fundamental research I was working on anyway. I was going to share this update on Canadian drilling and Canadian development and pipelines and so on. And so I'm working on that. I have my assistant helping me work on that. So I'm going to be putting out something that there's some things that are just crazy cheap, independent of this move on oil, that, you know, to the extent oil goes up a lot and to the extent we see a lot more wells drilled and to the extent that we see a lot more energy and security, which again, I'm opposed to generally. I think, you know, we should have more energy, not less. I think fossil fuels are fantastic from a global perspective. More abundance of fossil fuels leads to more human flourishing. So I'm generally in favor of more of these things, highly economically, but more of them. And so I think there are some of these companies that are going to make a lot of money anyway that may make even more money. And there's one or two trends that are happening here that I don't think people really understand just how beneficial they are to some of these services companies and some of these producers. And I'm going to share that. And again, can I change the overall perception of a company or a technology or a service provider? Probably not, but I can help educate. And I can share what I'm seeing. And historically, over time, I've done really well with lots of pain and lots of volatility. And again, this isn't solicitation, it's not a financial recommendation. Please, before you make any sort of investment which could incur a risk of loss, please consult your own financial advisor, do your own diligence. Do not rely on me. And with that, I will bid you adieu, and I'm going to open up a Bison Insights subscriber space to chat about some of these specifics, what I'm seeing and doing right now. Thanks.